Are you just tracking the market or are you actually beating it? That's the big question for Singapore's investors today, especially with the Straits Times Index flying high. So let's pull back the curtain, get real about what's happening under the hood, and figure out a strategy that's right for you. Hi, I'm Iggy, aka the Investing Iguana, ranked 8th among the 2024 influential tigers by Tiger Brokers, with over 1 million reads and 58,000 likes on the blog. I've created more than 1,000 videos with 600,000 watch hours as of August 2025. My focus, regional and global economic trends, but today it's all about the STI. This video is crafted from my latest in-depth Substack deep dive. Here's what we'll cover: the real makeup of the Straits Times Index, why your portfolio might trail the index, the buy or beat dilemma, and actionable strategies to boost your returns. Let's get started. Let's picture the STI as Singapore Inc.'s report card. Imagine a group project. DBS, OCBC, and UOB are the classmates who do most of the work and get most of the credit. The STI tracks the biggest 30 companies on SGX, but it's not an even split. It's weighted by market size, so the largest players sway the whole score. Maybe you bought an STI ETF for its simplicity or dividends, but it's not a basket of 30 equal companies. It's a heavy bet on the top 3 banks. When DBS moves, the index moves. A tiny stock could triple, but barely nudge the dial. If you want the full financial details and pretty charts, grab the original post on Substack, link in the description. So quick recap. When you buy the STI, you're riding with the top dogs, not joining an equal team. Here's a thought. If those giant banks stumble, what happens to everyone else? Does your portfolio wobble when their number dips? Pull up a seat. Let's walk into the STI's engine room together. Open the hood and you'll see banks everywhere. DBS, OCBC, UOB. They make up more than 40% of the STI's total weight as of September 2025. Imagine the index as a soccer team. Almost half are goalkeepers from the same club. If the financial sector shines, the whole team scores. But if banks catch a cold, everyone feels it. Now look at the sector concentration table. Financials dominate, leaving little space for tech, healthcare, or other growth sectors. Stability is good. Nobody likes roller coasters. But are we missing out on big leaps? Singapore's policies often favor stability in banking, with cautious regulation. But the world is shifting. Are we missing out on tech stars, new industries, and future blue chips? If you want to see the lineup, head to the Substack post for full visuals. Question: is diversifying beyond banks crucial now, or do you double down on stability? Now for the million-dollar question, with the STI smashing records, over 4,075 this October, should you invest? Let's break it down. First, valuation. The STI currently trades at a price-to-earnings PE ratio of about 12.1x, much cheaper than its 5-year average of 15.4x. That's like buying durians at half off. Pretty sweet deal. Second, dividends. Singaporean blue chips are legendary for payout. You're looking at around 5% yield. That's income you can see, useful for CPF planning, or just monthly budgeting. Third, ease of access. Buying STI via ETF is a breeze. SPDR ES3, Nico AMG3B, Cash, CPF, SRS, you name it. Check Substack for tables showing STI's valuation and yield snapshot. For all full charts, checklists, and the written playbook, grab this post on Substack. Link in description. Quick recap. STI is cheap, pays well, and is easy to buy. But let's pose a question. Is cheap and easy enough for the next decade of growth? Here's the flip side. Bank heavy means you're not truly diversified. A squeeze on net interest margins or a slowdown in banking can drag the whole index. Now let's talk missed opportunities. The SGX iEdge Singapore Next 50 Index tracks the top 50 companies left out of the STI. Guess what? Year to date, the Next 50 returned 25%, easily beating STI's 19.3% gain. Those rising stars, mid-caps, tech plays, emerging healthcare leaders are fueling Singapore's new economy. Check the visual table on Substack. The difference is clear as day. So ask yourself, if you stick with only the STI, are you passing up the Future Grab, C Group, or Parkway Life REIT before they hit the big leagues? So what's my verdict? It depends on who you are as an investor. Pull up the Investor Strategy Guide table for tailored advice. Passive investors use the STI as a core, set and forget piece. Given current valuations and yields, it's your stability anchor. Active investors see STI as a benchmark to beat. Don't let banks set your entire agenda. Explore Next 50 trackers and scout for sector rotation. Tech, healthcare, green energy, these are forging Singapore's next act. Singapore's markets reward discipline, but also those who seek out value. Don't be shy to challenge your ETF, dig into sector details, or cherry-pick high-yield REITs and telcos from within the index. Here's your challenge. Can your portfolio thrive both when banks lead and when new growth sectors break out? Are you prepared to ride both waves? Let's round off. The STI is a valuable tool. It reflects the strength of Singapore's most mature players, but it hides a world of opportunity outside its borders. Here's your actionable plan. Anchor your portfolio with an STI ETF for stability. Always know what you own. Monitor the trio of banks. Keep an eye on rates and profits. Hunt for growth. Add Next 50 midcaps and stay curious about tech and healthcare. Maximize income. Look at REITs and telcos for top dividend yields. With this knowledge, you're no longer just following the market. You're a smart, strategic investor ready for Singapore's next chapter. If you enjoyed this, tap like, share, and subscribe. Join the community as a free or paid Substack member. Link in the description for exclusive charts, actionable frameworks, and my written playbook. To go deeper, watch my next video, Singapore REITs, which yield the most in 2025. Stay sharp, stay curious, and keep investing with confidence. I'm Iggy, the Investing Iguana. See you in the next one.